And if you want to go into like other ways to protect your portfolio from crashes and stuff like that, in order to answer my my client's amazing question as to, what if you're in your 70s and your portfolio drops by 30% or even up to 60%. And that's something called portfolio insurance strategies.
Mm.
Now, this is a strategy that's often used much more in the professional world, but it's something that we can learn and we can adopt.
Hello and welcome to the Woke Finance Podcast, a podcast discussing all things finance and all things finance related. It's your boy Peter and I'm with my co-host, my bro Jax. How are you today?
Yes, Peter, doing very well. At the point of recording this episode, I am fully in my transition, moving away from corporate, at least temporarily, to becoming a full-fledged financial planner. So yeah, moving from asset management to financial planning has been an interesting move. But ultimately, yeah, I'm becoming more of an entrepreneur, they say.
I love it. I love it, man. We must do an episode just reflecting on that in general. I know many of our listeners, they might work in corporate, they might have plans to do something outside of it, or are already doing outside of it. So I think they'll definitely find value just listening to someone's story as well, and their journey. So no, definitely, would be good to do an episode sometime in 2026. Now, on the topic of 2026, and for our listeners, we've been doing a few episodes in relation to just preparing for the new year because it is coming towards the end of 2025. So this episode is going to be touching on a few things that we feel may or may not be coming in the next year or so. But before we do that, just for our listeners, a massive shout out to you wherever you are in the world. We appreciate you. We see you. We see your ongoing support. Please keep supporting us with the usual liking, subscribing, commenting, and sharing with others. If it's on your social media or just sharing the conversation about an episode with someone, it could be your spouse, your friend, your parent, your children, whoever it might be, your work colleague, and keep the conversation going. Now, back to the topic of this episode. As we said, we've been doing a few episodes, looking ahead for the next year or so, and I mean, you just have to turn on the news, and you'll see all sorts that's happening depending on where you are in the world. Over here in the UK, we've been given lots of warnings of further tax hikes. It's like never ending. All sorts is just happening. Soon government changes potentially very soon. All of that stuff. So it's all just happening. Or our current government so-called losing control of the economy. And what we tend to see in history tells us whenever we see some of these things, when they're actually true, and it's your decision to decide whether they're true or not, but when they're actually true, they usually point towards something. And one of the things that they point towards is an economic crash, which we see every now and then. As hopefully our long-time woke finance listeners are aware of. And this is quite timely, Jax, because one of your clients, which I'll hand over to you talk about, actually asked you an interesting question in regards to a crash, in particular to a particular group of people, age-wise, but this is quite relevant for anyone. So yeah, Jax, you want to give maybe a bit of context to what your client did say?
Yeah, so I mean, my client, what we were basically working on is basically a lot of financial education, stock market investing education, investment education. So one of the homeworks I gave him was to go back and look at the history of the stock market, look at things like crashes, look at the responses to those crashes by, for example, the central banks such as the Fed, etc. And so he did his homework, and during the next session, one of the questions he had for me was, Jacques, I noticed that sometimes the stock market can crash up to 30%, and in some cases, like the Great Depression, and also the global financial crisis, it can drop up to 60%. So what happens if you're already retired, let's say you're 60 or 70, and you're drawing from your portfolio, and your portfolio drops by a whole 60%? That's horrible. That can absolutely ruin everything that you've worked for your whole life. Why
Mm.
would you what do you do in response to that? How do we protect ourselves from something like that? And that was a very, very good question to ask, I believe.
Yeah, and it's an honest question. At the end of the day, I'm assuming your client, Jax, is not that client you're referring to is not 60, 70. So we don't really we don't really know because we've not experienced that. So it's really good to actually bring these questions because it allows us maybe for those that are, thinking about retirement, and that's pretty much anyone because we got a plan well ahead. We can think about what we can do in relation to that, and maybe those that are in retirement can maybe just assess a few things as well. But Jax, it's a legit question. Yeah, I mean,
Yeah.
how does one protect their portfolio from such a crash?
Yeah, first and foremost, you're right. The client is in his early 30s, so it's actually quite good that he's thinking about the future, and how to safeguard against potential huge crashes in the future as he starts his journey to build a hopefully a nice, sizable portfolio over the long term. To answer your question, I think this is an area that many people don't understand. It could very well be that they've watched some YouTube videos or they read some books, and those books will probably say, "Hey, invest in the S&P 500 or some sort of broad-based equity index," which is a great way to invest for the long term, in my opinion. So I do understand it. But when you invest in one asset class, which is equities or known as stocks and shares, you are susceptible to volatility and you're also, susceptible to these downturns and market crashes. So I think that the first answer that I gave him was that it's important to understand that when we are investing, we invest according to our objectives, our time frames, our risk tolerance, and that could be changing as we get older. Keyword there was time frames, right? As we get older, our time frame shortens. And so with that in mind, we must adjust what we call our strategic asset allocation. Our strategic asset allocation is essentially how much of our money is going to go into different asset classes. So how much is going to go into stocks or equities, which are the more volatile assets, but they provide the growth. They are the engine of growth in your portfolio. And how much is going to go towards less risky assets like bonds and cash instruments that are less risky, and provide a level of stability in your portfolio. And the younger you are, chances are you want a higher allocation to equities, right? Because you've got a nice long-term frame to ride, downturns and crashes. And ultimately, in the long term, you should make good returns. But the older you get, you should really adjust this strategic asset allocation. And that was my answer. As you get older, you should really have a majority of your assets in less equities and more in things like bonds.
Now, Jax, how might someone reach 60, 70, and gone through life and then found themselves with a portfolio where it's so exposed to pretty much equities only that maybe when that crash, and when, not if, when that crash does happen, their portfolio is affected so much. How might someone actually find it? Because as you said, what we should be doing is that strategic allocation and moving our funds outside of, I guess, more so-called riskier assets when you have less time to work with when you are older, obviously. How might someone actually find themselves in that situation that your client brought up?
Yeah, I think first and foremost, it's probably an educational piece. I think a lot of people don't understand the concept of strategic asset allocation. Majority of people, when they hear about investing, they only think about one asset class, which is stocks and shares,
Mm.
which you probably hear me mention as equities most of the time. And so when they are investing, they are only exposed to this asset class. There is no kind of understanding that there are asset classes like bonds, and even within the bonds asset class, you've got corporate bonds and you've also got government bonds, and their risk metrics are different as well. And then you've even got alternative assets, right? So you've got things like gold and other
Mm.
commodities, and then you've got infrastructure. So I think there is an educational piece to highlight to retail investors that is not just about investing in this one asset class. And yes, you may have watched YouTube or Instagram or read a few books here and there that do talk about, the good idea of building a portfolio by just investing in kind of like a broad-based passive index fund. That's good, but there is no understanding of, hey, actually, there are other asset classes that better suit my objectives and risk tolerance. But also, let's be honest, a lot of people don't use financial planners or financial advisors. And I think probably the big role that these people have which technically I am now, is actually really understanding what a client needs to achieve, really understanding the client's objectives, risk tolerance, etc., and then really building a portfolio that's bespoke and unique to that client. But unfortunately, I would say I heard someone say, and it's a bit more aggressive than what I would say, but he called it a self-directed disease, which means everyone wants to do things themselves. And I think there is something about learning how to build a portfolio yourself, and I like the idea. But I think a lot of people can benefit from actually speaking to someone who is trained, educated, and regulated, to put your interests at heart to help you at least, set up your strategic asset allocation, even if you don't pay ongoing fees and it's just a one-time transaction.
I guess that sets up the foundation, and then if you feel confident, you can take things from there. But it sets you in the right direction, essentially, in relation to
Absolutely.
your own personal finances.
Absolutely. And as I said, if you're just starting off, then potentially, yes, just having a broad-based index fund is fine. But I think the big challenge, and actually what I would say to everybody listening is in your accumulation stage, when you're just building assets, it's okay to just maybe, buy a broad-based index or, set up your own strategic asset allocation and learn how to do it. But most definitely, when you get to what we call your decumulation stage, which is when you're actually at retirement and you already have built up a pot, and now you need to find the most optimized way of living off that pot. And it's no longer just building wealth, now it's preservation and being able to live off that portfolio. I would say everybody needs to speak to a regulated financial planner in that respect. But once you get to that stage,
And it's about knowing when that stage, because I can imagine that stage isn't a one date for everyone. It might be different for different people depending on where they are in life as they get older and closer to retirement as well. So yeah, no, that's super interesting, really interesting. Okay, so we've got strategic asset allocation, and I think Jax, for anyone that's maybe not in retirement age, which is the majority of our listeners as well, if you are just heavily in one assets, I think it's so important that we are made aware of other assets because there will come a time when we will need to, undergo this process of moving funds into different assets. So the more you know about it earlier, the less alien it is when it comes to that time.
well, absolutely, absolutely. I would encourage listeners to start learning about it now. That earlier you were saying something about when it's best to start speaking to like a financial planner. Many people say maybe up to 10 years before retirement, right? Because
Mm,
probably before then you start preparing your portfolio
mm,
to be drawn from, right? You're gonna go into something called drawdown or something. So you want to start adjusting the portfolio's risk. What would be absolutely devastating is just a few years before retirement, we have a global kind of crash and your portfolio
mm,
drops significantly, right? So definitely I would say probably 10 years before your retirement age that you choose, right? Because this is a number that you can choose,
mm.
then you probably want to speak to a financial planner. But absolutely start learning about it now. And Peter, I was a special guest on a different podcast. I would just shout it out. It's called The Savvy Wallet by a guy called Ato. And one of the things I said on the podcast, which I truly believe in now, more so than ever, is that the best investment that anybody can make is the one that they're going to stick to, right?
Mm.
He asked me, why is it that 70% of retail investors lose money? And my answer was because majority of people are not investing according to their own mandates. They
Mm,
haven't built portfolios that actually suit their own risk appetites and stuff like that. So they may have, let's say, have 100% in index funds, but the moment there is some sort of volatility, they jump out.
mm,
And that's because they've not got the experience or the sometimes even the knowledge to know that it probably will bounce back up. But yeah, they've not invested according to the risk appetite. Maybe their strategic asset allocation or the portfolio needed to be in a less risky asset.
mm.
And though over the long term, the actual returns may not be as high as it would be if it was in 100% equities, but you would have made more money because you would have actually stuck to
Mm.
the portfolio that you created.
And maybe being at a bit more peace, mental
Yeah,
peace, where you don't see
sleep at night.
certain.
Yeah.
Yeah, no, it's interesting because you don't know what you don't know, right? So if you just go in all guns blazing, index funds, equities, cool. But you don't, if you're not aware of, an actual portfolio that actually reflects your own risk tolerance and your own mandate, you don't know what you don't know. So if you didn't know, maybe, there are things like bonds that you can put your money into and all of that stuff. Yeah, and then all of a sudden you can be hit with a reality check when something like a crash does happen. So listening to episodes like this, going to financial plans, whatever, what that does do, it really just really gives you a whole, I guess, a holistic view, so you
Yeah,
can make more of an informed decision.
absolutely. That's correct. That's absolutely correct. And if you want to go into like other ways to protect your portfolio from crashes and stuff like that, in order to answer my my client's amazing question as to, what if you're in your 70s and your portfolio drops by 30% or even up to 60%. And that's something called portfolio insurance strategies.
Mm,
Now, this is a strategy that's often used much more in the professional world, but it's something that we can learn and we can adopt. It is less of a long-term strategy compared to your strategic asset allocation. So your strategic asset allocation, which is how much will go in stocks, shares, bonds, and that kind of stuff, is more of a long-term strategy. And you don't deviate from it too much unless, let's say, there's a life event or something drastic happens that you need to adjust. But portfolio insurance is more of a short-term protection in a portfolio. And often what you would do is something called a hedging strategy. Again, this is something that you can learn. And probably it goes beyond this episode as to how to actually do it. But essentially, you can use something called derivatives, where you can take the opposite view of what your portfolio represents for a short period of time. So example is all of us will be long. Let's say long basically means we own the assets. Let's say we own, let's say the S&P 500, and that's what we're building over the long term. But you feel as if the S&P 500 is overvalued and you want to protect your portfolio over the next, I don't know, 3 months, 6 months, 12 months, so up to a year. So let's say the whole 2026, you can do something called going short, which is essentially betting against yourself, really and truly, by paying a small fee called a premium. You bet against the actual S&P 500 for that period so that you are hedged, which means you actually won't make money, but you also won't lose money if you're fully hedged. And essentially, that can protect your portfolio for a short period of time. And all it would have cost you was that fee rather than you actually losing money when the stock market goes down. So that's more of a short-term fix. And I suggest that most people probably can learn how to do it, but it's not my favorite way for the retail investor to do.
mm. And why is that?
I think because retail investors struggle with understanding whether the market is overvalued in the first place, but I also suspect that most retail investors will probably get it wrong.
Mm,
And again, it takes skill to be able to even know how to fully hedge a portfolio. And because it's too much of a short-term strategy, I think this is something that it should be left to more of the sophisticated
mm.
investors, those that are a bit more experienced, and those that are actually managing bigger mandates.
Understood, understood. Okay, so I think, we're pretty much gearing up for a potential crash in 2026, if not earlier. And again, this is just based on what we are seeing. One may happen, one may not happen, in next year. I mean, one thing we probably do know for sure that one will happen at some point in time. I love how YouTubers love to predict stuff and say, "Hey, see, I told you." I mean, come on, it's always gonna happen. But no, Jax, I guess in terms of this and just preparing, I guess for retail investors, is there any other key considerations that they need to take in place?
Yeah, absolutely. I think we must, like you've correctly said, ultimately we should expect these things to happen. So one of the thought experiments I encourage clients to do is literally just to close their eyes and to imagine the amount that they have invested or the value of their portfolio. Just imagine it going down by 30%, which means just multiply the value of your portfolio today by zero point 0.7, and that should tell you what it should look like if there was a 30% drop. and ask yourself, how do you feel about what you see? Does it make you feel very uncomfortable, etc.? If it makes you feel very uncomfortable, then ultimately it means you need to change your strategic asset allocation. It means you have not actually invested according to your own risk appetite. So that's something you can do today. That's an action point that people can practice. But ultimately, I think it's really important to remind ourselves of history and remind ourselves that ultimately crashes often follow huge gains. So one of the things the client told me was, imagine the portfolio going down by 70%. That's crazy. I mean, it rarely happens, but imagine that happened. And I said to him, well, let's look at the history of when it did drop by 70%. What happened in previous years before that? And he noticed that 10 years before that, the portfolio had gone up by 400%.
Mm,
So I said to him, well, that's the thing. If your portfolio goes up by 400% and then drops by 70%, you've still done quite
mm,
well, right? So it's always remembering that most of the time these drops, these crazy numbers that you see that they drop by are often following bubbles or lots of like high returns anyway, such that the ultimate long-term return is not affected as much as it initially looks.
mm. I guess our mind tends to always remember the drops.
Yeah, yeah, because we have an emotional bias called the loss aversion,
Mm,
which I think the number was 3.5%. What I mean by that is we feel the pain, or 3.5 times, we feel the pain of losses more than the pleasure of gains. And so that's why I remember the crashes a bit more than the gains. But yeah, it's really important to understand that. I'm a final thought on this as well is not only are crashes following from huge gains, but often after crashes, gains follow after that as well. So
mm.
in that history kind of lesson that we had, I also noted to him and I made him aware, or I pointed out to him that, have you noticed that whenever we have a crash, there are, it recovers. It has always recovered. And actually, over the years, because we started from 1900, over the years, we realized that now when a market crashes, it actually recovers much quicker than it used to before as well. And that's because of things like policy. And also that's also because a lot of the time when crashes happen, the response to that is how can we, as an economy, put measures in place so that it doesn't happen again. But as you said, it doesn't mean another crash is not going to happen. History tends to rhyme, but will never be exactly the same because of the measures put in place. And we always have policy, we always have responses by central banks that supports the stock market over the long term.
Hmm. Love that, man. A few ways for us listeners to protect ourselves from a potential crash coming soon. And shout out to those that ask us questions in many different ways as well, including the client that brought this up as well. Jack, very quickly, we're gonna give a shout out to where we're getting listeners from, and this area is called Cambridge, not the Cambridge you're thinking of, but actually this is in Australia.
Yeah, we tend to have a lot of similar cities in Australia, in America, etc. Welcome to the Woke Finance Podcast. You're here with myself, Jax, and the co-host Peter. And on this podcast, we talk about all things finance and all things finance related. If you want to know more about what we do in the community, you can head over to www.wokefinance.co.uk. That's www.wokefinance.co.uk. And if you want to engage with us on social media, we are on three platforms. That's TikTok, Instagram, and LinkedIn. If you search for Woke Finance, you'll be sure to find us. Welcome to the episode. I hope you are enjoying and gaining tons of value.
Come on, come on, come on. A massive shout out to our listeners over there. Jax, any final thoughts or words of encouragement for our listeners here thinking, okay, 2026 is coming.
Yeah, I think the first and foremost thing is nobody knows what's going to happen next. Nobody knows. I mean, this year people thought there was going to be a major crash this year,
Hmm.
but we've gone another year where the market has returned above even 20%. So absolutely nobody actually knows what's going to happen next year. So just put that in mind. But secondly, crashes are part of the game. But history will show us that crashes don't last as long as they used to, first and foremost, but it has always recovered. The key thing is, as you are investing, like I've kind of reiterated this whole episode, is to make sure that the portfolio that you have actually represents what you're trying to achieve, but also considers your personal risk appetite. Really, really important to do that. And to remember, this is always a long-term thing. And when crashes happen, not only should we remain steadfast and understand that it's part of the game, but also it presents an opportunity to continue building your asset base now at even cheaper prices.
Hmm. Love it, love it, love it. Now, thank you very much for that, Jax. Always a pleasure for our listeners. Hopefully, quite a useful episode for you. So just listening wherever you are. Do continue to check out our episodes. Jax made also reference to a recent podcast he jumped on not too long ago. That was a really good episode. So do make sure you check that out. We'll put it in our description. That's Savvy Wallet. So shout their podcast as well. And yeah, for our listeners, remember all
Stay
stay woke.
woke.